If you're earning money outside a normal paycheck, the IRS probably knows about it already, and most people don't realize what that actually means for their taxes. The reason this matters is that the system for catching mismatches has become almost automatic, and ignoring a small side income can cost way more than reporting it honestly ever would. Let me explain what's actually happening behind the scenes, because this is the part nobody talks about clearly. The IRS isn't looking for criminals. They're looking for patterns. Specifically, they compare what you claim on your tax return against what banks, payment platforms, and other businesses report directly to them. When those numbers don't line up, a computer flags it immediately. No human has to notice. No audit letter gets written right away. The mismatch just sits there, waiting until you either file again or someone pulls the record during a routine check. Here's the key thing that changes how you should think about this. The size of your income doesn't protect you. $1,000 matters as much as $10,000. The IRS isn't being lenient because the amount is small. They're being consistent because the rule is the rule. You report what you earn, or you deal with the consequences of that choice later. Now, a lot of people assume they have time. They think they'll report it next year, or they'll wait until they get a form in the mail, or they'll handle it once the side hustle grows into something real. That's the mistake that compounds. Let me walk you through how this actually works in practice. When you earn money through platforms like Uber, Fiverr, Shopify, or even through cash payments from clients, multiple things happen at once. The platform or your client may issue a 1099 form at the end of the year. That form gets sent to the IRS too. Your bank sees deposits. If you use a payment app like PayPal or Venmo for transfers, there's a record. If you get paid by check, there's a clearing record. If someone pays you in cash, your bank still sees when that cash hits your account. The IRS has access to all of it, either directly or through matching systems. The matching happens like this. You file your tax return and claim certain income. The IRS runs that return through their database and checks it against what third parties reported about you. Your 1099 from a freelance client says you earned $5,000. Your return says you earned $3,000. That's a match problem. A computer flag triggers later. When someone processes that flag, it becomes either a letter asking you to explain the difference. The penalties are where this gets expensive. If the IRS assesses you for unreported income, they don't just ask for the taxes owed. They add interest, calculated from the date the income should have been reported. They may add a penalty for underpayment, which ranges from 10 to 25% of what you owe, depending on how long the error went undetected and whether it looks intentional. What started as $500 in taxes owed suddenly becomes $1,200 in total liability. Then there's the time cost. You're exchanging hours of your life for phone calls, paperwork, and explanation. Most people don't think about this cost clearly. They focus on the immediate tax amount and assume it's not worth dealing with until necessary. But the actual cost includes the penalty, the interest, the stress, and the time. When you add all of that up, reporting correctly from the start is always cheaper. Let me show you some concrete examples, because this is where the reality becomes clear. First scenario, you drive for a rideshare platform. You make about $200 a week, so roughly $10,000 a year. You don't set aside taxes because you assume that's not real income yet. Come tax time, you haven't reported it. The platform issued a 1099 form to the IRS. The IRS notices you didn't claim it. At a combined tax rate of roughly 25%, that's federal plus self-employment taxes. You should have paid around $2,500. Now you owe that amount, plus interest at about 8% yearly, plus a 20% penalty for underpayment. Your actual bill becomes closer to $3,800. The unreported income cost you $1,300 more than if you just filed it correctly. Results vary based on your specific tax bracket and state taxes. Second scenario, you freelance on the side, earning $3,000. You do the work for a marketing client. The client issues you a $1,099 NEC. You're not sure whether you need to report it because you only earned $3,000 and your main job pays $60,000. You think it falls below some threshold. There is no threshold. Income is income. The IRS sees the 1099. They see you didn't claim it. They send you a letter. Now you're dealing with a compliance issue. You have to prove where the money came from, why you didn't report it, and you end up paying roughly $900 in taxes and penalties. The stress of the letter alone causes people to lose sleep. Results vary. Third scenario, you sell items online. Sometimes profitably, sometimes not. You've had about $4,000 in revenue over 6 months, but your actual profit is only $800 because you spent $3,000 on inventory. If you report the revenue but forget to mention your expenses, you'd owe taxes on the full $4,000. But if you don't report anything because you think it's a hobby, the IRS can still demand taxes on the revenue side. The correct approach is to report both the revenue and the legitimate business expenses. That way you only owe taxes on the actual profit, $800. The difference between claiming the full $4,000 versus just $800 is roughly $800 in taxes. Most people get this wrong because they don't separate the concept. Here's what triggers IRS attention most directly: mismatches between what you report and what institutions report about you. Large unexplained deposits into your personal bank account. A sudden increase in deposits without a corresponding change in income on your tax return. Multiple income sources with tiny amounts claimed. Say you have 4 different 1099s for $200 each, but you only claim one of them. Multiple people reporting income from you, but you're not claiming it as a business. These patterns are easy for automated systems to catch. The clean way to think about compliance is to separate tracking from reporting. Most people mix those up. The tracking means keeping independent records of what you earn. Don't rely on 1099 forms. Those forms come late, they're often wrong, and you shouldn't wait for them to start tracking. Instead, create a simple spreadsheet the day you start earning the side income. Log every payment. Include the date, the client or platform, the amount, and what you did to earn it. This takes 5 minutes per transaction. By the end of the year, you have a complete record that you own. Reporting means putting that tracked income on your actual tax return. Whether or not you received a 1099 form, if you earned the money, you report it. The form is nice to have because it confirms things, but the form is not the trigger for reporting. Your income is... Now here's the twist that most people miss: separating your business money from your personal money isn't just about organization. It's about proof. If you run your side income through a personal bank account, you have a problem when it comes to expenses. You'll have coffee purchases, dinner, gas, and other personal spending mixed in with your actual business purchases. You might spend $100 on office supplies and $500 on groceries in the same account. During an audit, you can prove which purchases were business and which were personal. Either you lose deductions you actually earned, or you claim personal expenses as business expenses, which creates a new problem. Opening a separate checking account costs almost nothing, and it solves this completely. Every deposit is business income. Every withdrawal is a business expense. When an auditor asks where something came from, you have a clear answer. This is the part that changes things. Documentation is easier than explanation. If you document things clearly as you go, you never have to explain anything later. You have dates, amounts, and a narrative of what happened. If you skip documentation and wait for an audit to explain what happened 6 months ago, you're working backward. Your memory is worse. The facts are hazier. The stakes feel higher. You can get things wrong just because you're under pressure. Documentation as you go eliminates almost all of that stress. Let me walk through what a reasonable tracking system actually looks like, because this is where people often get stuck thinking it's complicated. You need 4 things. 1. A way to track income. This can be a Google sheet. In one column, put the date; in another, put the amount; in a third, put who paid you and for what. That's it. 2. A way to track expenses. Same format: date, amount, what you bought, and what business purpose it served. 3. A bank account, separate from your personal account. Even a basic savings account works. All your side income goes there. All your business expenses come from there. 4. Receipts. Take a photo of receipts or save digital ones. You don't need to organize them obsessively. You just need to have them. A folder on your phone works fine. That's literally the entire system. It takes less than 10 minutes per week if you stay on top of it. At the end of the year, you have everything you need to file correctly, and you have everything you need to defend yourself if someone asked questions. Most people don't do this because it feels unnecessary until it's necessary. Then it becomes urgent and stressful. The people who avoid IRS problems aren't smarter or luckier. They just did the simple thing early instead of the hard thing late. Let me address a specific concern that trips a lot of people up: cash. Cash payments are real income. If a client pays you in cash, you have to report it. There is no exemption. The reason people think cash is invisible is because cash leaves no immediate trace. Nobody reports that they paid you in cash to the IRS automatically. But here's what happens if you deposit that cash into your bank account. There's now a record of the deposit. If you make consistent deposits of cash every week, the pattern is visible. If someone audits you and asks where the money came from, you need to explain it. If you can't, you've got a credibility problem. Even worse, if the income was actually earned, but you can't prove it, you might lose the ability to claim legitimate business expenses because the auditor questions whether the whole operation was legit. The solution is the same track. Write it down when you receive it. Keep a record of the payment, the client, the date, and what you did. Then when you deposit the cash, you're not depositing mystery money. You're depositing documented income. There's a trail of evidence that makes sense. Here's something that shifts how people think about this setting. A side money quarterly is cheaper than paying a big bill at tax time. If you earn $10,000 in side income and you owe 25% in taxes, that's $2,500. If you wait until tax time to pay it, you're fine, technically. But if you didn't set aside that money, you now have to come up with $2,500 when you file. Most people can manage it, but it's a shock to the system. If you set aside $625 per quarter, you never feel the burn. By the time you owe the money, you have it sitting there. No stress, no scrambling, no temptation to underpay because you don't have the funds. Here's the thing about quarterly estimates that most people get wrong. You don't have to be perfect. You don't have to know your exact income. You estimate conservatively. If you think you'll earn $10,000, you assume you'll owe 25% and set aside $2,500. If you earn less, you get a refund. If you earn more, you owe a bit more. Either way, the major amount is already accounted for. Now let me address what actually happens when you get it wrong, because understanding the consequence makes the prevention obvious. You get a letter, it's not the end of the world, but it feels like it the first time. The letter says something like, "We've identified unreported income on your return." It'll specify an amount. It'll ask you to either explain why the income shouldn't be reported, or to file an amended return with the correct amount. You have a deadline, usually 30 days, to respond. Most people panic at this point because they don't know what to do. What you do is straightforward. You amend your return. You file Form 1040X for the year in question. You include the missing income. You calculate the taxes owed. You pay them. The amended return goes to the IRS. They process it. You're now compliant. The whole process takes a few hours if you're organized, or maybe a few $100s if you hire someone to do it. The penalty for not responding is worse. If you ignore the letter, the IRS can assess you for the full amount without giving you another chance. They can add penalties. They can pursue collection. That's when it becomes a serious problem. This is the part that clicks for people. The IRS wants you to pay. They're not trying to trap you. They're not trying to ruin you. They just want the correct amount of tax from everyone. If you report it correctly from the start, nothing bad happens. If you don't, they'll eventually ask you to pay, plus some extra penalties. The whole system works better when you report early. Let me give you the checklist that prevents almost all of this. 1. Start tracking side income on day 1, not day 365. Use a simple format: date, amount, source, what you did. 2. Open a separate account if your side income is recurring. If it's a one-time payment, less critical, but it still helps. 3. Track business expenses in the same way. Every legitimate purchase gets logged. 4. Don't wait for forms. Report your income on your tax return even if you haven't received a 1099 yet. 5. File your return accurately and completely. If you're unsure, get help from a qualified tax professional for that year. They're worth it if it prevents one mistake. 6. If you get a letter from the IRS, don't panic. Respond, either explain or amend. 7. If your side income grows or becomes regular, consider setting up proper business structure and paying estimated quarterly taxes. This depends on your situation, but it gets more important as the income grows. Most of this is just being honest and organized. There's no secret, there's no hack. The people who never have IRS problems aren't using tricks. They're just doing the basic thing correctly. Let me circle back to why this matters beyond just avoiding letters. When you report income accurately, you get to claim legitimate business expenses. Those expenses reduce your taxable profit. If you earn $10,000 and your expenses are $2,000, you only owe taxes on $8,000 in profit. That matters. It's the difference between owing $2,500 and owing $2,000. Not reporting, on the other hand, means you owe taxes on the full $10,000. The penalty for dishonesty is worse than the tax on profit. Also, when income is properly reported and documented, it shows up on your credit history and your income history. That matters when you want to buy a home, get a business loan, or prove income for any reason. A home loan application asks about side income. If you can prove you've been reporting it, the lender won't count it toward your qualifying income. If you can prove it because you filed taxes correctly, suddenly you can borrow more money. Here's the last part that changes everything. Most people who think they're being smart by not reporting are actually being penny-wise and pound-foolish. They save a few $100s in taxes by not reporting. Then, when the IRS eventually notices, they pay that few $100s plus penalties, plus interest, plus the cost of dealing with it. They could have just paid the original amount. Instead, they paid more, plus they had stress, plus they spent time explaining themselves. The math doesn't work out for not reporting. The people who come out ahead are the ones who report accurately from the start, claim all their legitimate expenses, document everything, and move on with their lives. It's boring, it's not exciting, but it works. Think about it this way. The IRS is doing matching work automatically now. They have tools to compare your claims against third-party reports. That's not going to stop, it's only going to get more comprehensive. Fighting that system is fighting progress. And it's a fight you'll lose eventually. Accepting the system and working within it is the smarter move. The 3 things to take away from this income is income regardless of amount or source. Documentation as you go beats explanation under pressure. And correct reporting plus legitimate expenses always beats the penalty and interest path. If you earn money outside your main paycheck, start tracking it this week. Not next month, not when it feels big enough. This week, spend 5 minutes setting up a spreadsheet or opening a separate account. Then keep spending 5 minutes a week staying on top of it. That's the difference between peace of mind and stress later. If you want to dig deeper into side hustle taxes or business deductions, there are resources available that walk through the specifics for your situation. A qualified professional can help clarify what applies to you specifically, because tax rules have nuances that depend on your income level, state, and the type of work you're doing. But the foundation is always the same track: report, document, and stay compliant. It's that straightforward